right. Good morning, everybody. Thank you so much for being here with us today. My name is Ty Robinson. I'm going to be sort of the host for today's webinar. We're going to be doing the very popular Investing 101 presentation today. But before we get into our content today and meet our wonderful host, I'm going to do just a bit of bookkeeping stuff. So today's Zoom is in webinar mode. I'm sure you're all very familiar with Zoom presentations at this point, but just to let you know how this one's going to work, that means that all of your attendees are automatically muted and your cameras are off. So feel free to have your lunch, take a break. You don't have to worry about coming on accidentally. You can just enjoy the show. We are also going to mean that we're going to be using the Q&A feature today for any and all questions instead of the Zoom chat. We definitely welcome all questions. But in order to make sure that those are organized and we are able to get to them in a timely manner, we want to make sure that we're going to be having all those questions in the Q&A feature on Zoom. So if you have any questions at any time, please throw them up in there. We're going to try to have them be answered sort of as they come in if we can, but there'll also be time towards the end for just more of an actual live questions and answering. So that would be great. And then I did just want to quickly mention that today's presentation is going to be recorded and will be available on our YouTube page for free, along with all of our other presentations. You will also get a follow-up email after today's presentation that has both the link for the recording and a survey you can take. We read any and all surveys that get sent to us. We do like to make sure that we're always improving these types of webinars and presentations. So please let us know your feedback. All right, so next slide is going to be just a little introduction to our team. My name's Ty, as I mentioned. We have Jen in the background, the manager of our community engagement team. Our team here at the Harvard Federal Credit Union, we are the ones that are like always trying to make sure that we get out in the community and we find different ways to give back, whether that's through like donations and volunteer events and doing a lot of financial education content, just like today. So that's our team. And then just a little overview, I wanted to talk about the difference between banks and credit unions before we get started, because a lot of people actually don't know. It's one of the #1 questions that we get is what is the difference? So credit unions are actually not for profit. What that means is that we do everything a bank does. You know, we have checking accounts, savings accounts, loans, credit cards. We do all of the same stuff, but because we are not for profit, that means the profit that we would make as a financial institution, we give back to our community and to our members in a lot of different ways. In fact, all members are partial owners of the credit union. They're able to vote on big decisions and things like that. And the ways that we are able to give back is we have lower rates for a lot of different products and credit cards and things like that, or higher rates when it comes to savings accounts. We actually have a lot fewer fees and stuff like that. And we're always trying to find ways that we can give back to our community. So if you want more information, our website has all sorts of information. We also have the free presentations on our YouTube. You can learn all about the credit union and all the other topics that we talk about. But today you're here to learn about Investing 101 with our very own Shahar Ziv. So Shahar Ziv is actually the co-founder of the Harvard Personal Financial Management Wintersession course, which is pretty amazing. And he is thrilled to be back to teach the program for his 14th year. He is a graduate of Cornell and the Harvard Business School, and most recently worked for PayPal. He is a contributing writer for Forbes and serves on the board of directors here at the Harvard Federal Credit Union. So we're very fortunate to have him here today, leading a presentation for us. So Shahar, take it away. Thank you so much for being here.
Awesome. Thanks so much, Ty. Hi, everyone. Thank you so much for taking time out of your day to be here to talk about investing. So I know Ty gave a little bit of background. I do want to just answer an initial question, because anybody that's presenting to you, you should probably ask a question of why should I be listening to this person? So as Ty mentioned, I've been doing this now for about 14 years and actually was, a co-founder for this program. Really passionate about teaching personal finance. I do it across a lot of universities, a lot of different employers. I write about it, I speak about it, but really what I want to highlight here is on the bottom, which is I am as objective as you're going to find on this topic. I'm not trying to solicit you to manage your investments or, to give me money or anything of that kind. I'm not recommending any product or service that I receive outside compensation for. In other words, I don't have any conflicts of interest on the advice that I'm giving you. And I, say that very proudly for myself, but also as essentially a first lesson for all of you, especially when it comes to a topic like investing, but, personal finance overall. There are a lot of people who are very motivated to help you and to put your best interests first. Unfortunately, in the real world, there's also some people who don't necessarily have your best interest at heart. And it's really important for you to be a little bit skeptical and to approach anything that you're listening to or hearing with at least a grain of salt and understand, why is this person recommending this? Do they have any conflicts of interest that would prevent them from giving me the best advice? So hopefully this just, is a data point that, I don't have any of those conflicts, but also a good lesson to keep in mind whenever anyone is giving you any type of, I would say, financial guidance or really any other type of guidance. So just to set expectations, we have about 55 minutes here, and you may know one or both of these individuals. It's Warren Buffett, who's the legendary founder of Berkshire Hathaway. On the right is Melody Hobson. She's the amazing CEO of Ariel Investments. These are two of the best investment minds out there. In our 55 minutes, I cannot turn you into either of them. I really, really wish I could. Today is really about starting to build your investing toolkit. We'll talk about some facts, but really what I want to start to do is build some intuition and some insights and strategies that you can leverage as you start to think about investing and growing your wealth for long-term financial security. So I know in some of your classes, usually you kind of work through the semester and, towards the end, you maybe get to some of the ahas or kind of the answers. I'm actually going to flip it and I'm going to give you the secret to investing upfront. And so first of all, let me tell you what the secret to investing is not. Secret to investing is not investing everything in meme stocks like GameStop. And I'll tell you, even though where Bitcoin is today, the secret to investing is not investing everything in crypto. That is a gamble. You're welcome to gamble, but gambling is very, very different from investing. So here's the secret to investing. 2 words: be average. Now, I'm standing here in front of a cohort of Harvard undergraduates, and I'm telling you to be average. This is the most counterintuitive thing you've heard definitely today, probably this year, and frankly, maybe your entire life, right? Nobody has ever told you to be average. Your parents never told you aim for mediocrity. But the secret to investing is actually to be average. And I'll show you what that looks like. And here's the paradox. When you aim for average, you oftentimes, when it comes to investing, come out above average. And now let me start to kind of prove my claim here. So we talked about Warren Buffett. Warren Buffett has created an amazing business, but what he also says for the vast majority, 99% of Americans, he says, if you're investing, you should invest in the average, stocks. And what he means by that is, don't try to pick and choose individual stocks. Invest in the stock market as a whole. And he is so confident in that he basically put his money where his mouth was. And he said, I will put up $1 million of my money that my average investment will outperform whatever another party wants to do. And a hedge fund named Protege Partners took him up on it. This was a win-win because the money would go to the winner's charity, but the results were not even close. So when you talk about kind of an average investment, and we'll get into this in a little bit more, Warren Buffett invested in what's called the S&P 500. This is basically investing in the stock market as a whole and looking essentially at 500 companies that are pretty well representative of the stock market. And all he was trying to do was basically mimic the performance of the stock market, not try to pick winners and losers. Protege Partners actually tried to pick winners and losers and invested in 5 different hedge funds. And you can see that the results were not even close. Warren Buffett's average investments returned 125% over the 10-year time frame. And Protege's overall return was between a third and a fourth of that, 36%. You can see that even their best performing investment, Fund C, didn't actually outperform Warren Buffett. So again, aiming for average will most often get you above average returns. And yes, these are net of fees. And we'll talk a lot about expenses and fees a little bit later, but these are net of fees. So that's a little bit, and frankly, if you take nothing else from this, remember to aim for average. But let's now kind of start to unpack this in a little bit more detail and build the intuition. So investing is actually really, really important for a couple of reasons. One is it's one of the only proven ways to build long-term wealth. And really, it's the only way that you can actually outperform inflation. Inflation has been in the news a lot the last couple of years. It's run, pretty hot. But if you look at the average savings rate, especially kind of, net of inflation, if you look at the return of bonds, and I'll talk to you a little bit about what those are, you see that the returns are relatively meager. The only kind of place where you can outperform inflation in the long run is by investing in the overall stock market. And let me show you that in a different form. If you were to have invested $1,000 in bonds and stocks in 1915 or 1914, and you looked at the growth of that, in 2014, you would have had close to $3,000 in bonds. Great, you tripled your money. But that $1,000 would have been over $2 million if you invested in essentially the stock market. So you can see the difference and how the difference really kind of grows exponentially between investing in different mechanisms. Now, let me give you a little bit of another intuition around why it's so important to start thinking about investing early on, especially for the long term. So imagine you're walking down the street one day and you pick up a penny, except this isn't a regular penny, it's a magical penny. And it's magical because it doubles in value every single day. So on day 2, you have 2 cents, day 3, you have 4 cents, then 8 cents, 16 cents, etc. Any guesses as to how much money you have on day 31? Feel free to put it as a question in the Q&A. And again, like nobody's grading you on this. Like you can do this anonymously. Like there's no right, there's no shame in putting out a guess. You think you'd have $100, $1,000, $10,000 more? Any guesses? So I see one answer. It says 1 to 10 mil. And that's actually a very, very good answer because the answer is actually $10.7 million. 1 penny over 30 days grows to be over $10 million. That's a huge, huge gain. Now, let me ask you, I want 2 more scenarios. One of them is, imagine, on that first day, you walked and you actually didn't see the penny. You were too busy texting your friends, calling your parents, posting something on social media. And imagine you only picked up that penny and saw it on day 2. How much money would you have at the end of that same 31-day time period on day 31? Give you the answer. The answer is actually half, call it $4 million. Still a pretty good amount of money, right? What if you only picked up that penny on day 10? This is where the numbers start changing quite a bit. You'd have $21,000. Don't get me wrong, $21,000 is a lot of money, but it pales in comparison to $5 and $10 million. So what's happening here? And the title of the slide is exactly the concept I want to talk to you about, which is the time value of money. So as you leave your money in the stock market, if it's invested, it starts to actually grow exponentially. And this is really illustrating the concept of the power of compound interest, where as you start earning money, you start earning money on top of that, money that you earned before. And the more time you have, the more that money starts to really grow. Now, a couple things to point out here. In all these situations, the money is doubling every single day. But from an absolute dollar perspective, the numbers start to get really big only later on. If you're going from day 5, let's use this, day 1 example. If you're going from day 5 to 6, yeah, your money's doubling, but you're making 16 cents. Even if you're going from day 9 to 10, you're making $2.50. But when you get down here and you go from day 29 to 30, you're making $2.5 million in one day, or $5 million in a day. So the last doublings are the one where, from an absolute dollar perspective, those are the ones that really matter. That's when your money's really growing a huge amount. But in order to get there, you have to start early. Look at what happens when you start on day 2. You're essentially missing out on one period of doubling, but that period of doubling is $5 million. And so the more time you leave your money in, the more it's going to start to grow and the more opportunity you have for those doublings to occur. The flip side is you can see the consequence of delaying starting to invest or, let's say, save for retirement. If you were to wait 10 days, or let's translate this a little bit differently, 10 years, you can see how much less money you would have. So really what I want to kind of illustrate here is just the importance of starting to save and invest early and the importance of doing so consistently. So let's start to dive a little bit into the mechanics and how you actually invest and think about where you should invest, how to invest, and kind of start to build a foundation around that. So these are just some of the themes that we'll cover, and these are some of the things I want to kind of build your intuition around. It's going to be a little bit theoretical, and then we'll start to get into, into some actual practical examples, if you will. So look, I know many of you, especially if you're here, you're eager to start or kind of continue investing. And I know especially, there's always a question around like, okay, like how do I make money really quickly? What I want to say is actually, even before you start to think about investing, there are some really important things that you want to kind of do to make sure that your foundational financial security is taken care of. Some of those are actually building up an emergency fund, a stuff happens fund, making sure that you don't have a ton of high interest debt. If you go back to one of those first slides, historically, on average, the stock market returns 7 to 8% a year. If you have credit card debt and you're paying 20% interest a year on that credit card debt, even if you're making 8% by investing, you're losing money because you're paying more in debt. So there's always a question of, where's the optimal place to kind of put your money. And otherwise, there's probably some other really important, kind of items that you want to kind of take care of. There's a question that came in just around the compounding, which I'll just quickly address, which was compounding relies on reinvesting the earnings. How do I implement that automatically in practice? It's a great question. Essentially, if you were to open an account and put your money into, kind of mutual funds, and we'll talk about, or stocks or anything of that kind, usually in that account, you'll have the option, the money that you earn will stay in that account and actually just be used to kind of buy additional shares. And you'll be able to kind of either check a box or make a decision around, I want to withdraw my earnings every time, or I just want to reinvest them automatically. So usually when you open an account, you'll be able to make decisions around automatically reinvesting any earnings that you have. It's a great question. So I know I've already mentioned some terms, and I do want to take a step back just to kind of level set with everyone around some of the different terminology that you might hear and that we'll talk about a little bit here. So, checking and savings accounts, these essentially are accounts where the money that you put in is, especially up to a certain limit, a pretty high limit of $250,000 per account, protected from loss. And oftentimes in these accounts, you will earn interest on the money you put in. It's not a lot, but it's there. These types of accounts you'll find at credit unions, banks, online banks. You might hear about money market or certificates of deposits, which can earn you a little bit more in terms of money. But the terms that we're going to talk a lot about are the ones kind of towards the bottom. So bonds are essentially an IOU from either a company or the government that's issued when they're trying to raise money for something. And it's basically debt that a company or government is issuing. And when you buy that, you're essentially buying an IOU from that company that says, you've lent us $1,000. We will give you that back and promise to give you that back in 1 year, 5 years, 10 years, along with a little bit of interest. A bond is debt that a company takes on. A stock actually means that you own a piece of that company. So if you own a share of Apple, you actually own a part of the company. It's a really, 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 really tiny part of that company, but you actually own a piece of that company. And you make money as that company grows and does better, or if certain companies give out what are called dividends, which essentially is kind of like a payment every quarter, and you can earn money through dividend payments. Now, you can buy bonds and stocks individually. There's also ways of buying a collection of stocks and bonds, and this is what we refer to as mutual funds. Mutual funds can be a group of anywhere from a few to hundreds of different stocks and bonds that are put together to kind of make it easier for you to diversify what you're investing in. And some of you may hear another term which is called kind of an exchange traded fund or an ETF, which is very similar to mutual funds. I have a slide in the appendix, which you can see later about, the differences, but ETFs, for all intents and purposes, very similar to mutual funds in that they are a collection of stocks and bonds. So I want to take those items that we just talked about and put them on a spectrum of risk. So checking and savings account have very low, if any, risk at all. In other words, if you have $1,000 in your credit union checking account, that money is safe. Even if for some reason that credit union, goes under, you are insured by the Federal Deposit Insurance Corporation and will get that money back. As you start to move to the right, things take on a little bit more risk. So bonds have some risk, and there's different ratings of bonds. Some are less risky, some are more risky. Individual stocks, can have a lot more risk. Mutual funds, because they're a group of, different stocks and bonds, tend to have slightly less risk. And what I'd say is you actually have even more items that are on here. So like crypto is, a pretty risky investment as well. Now, the reason you want to understand the riskiness of each investment choice is that you probably have an individual risk tolerance that you're willing to take. But also when you think about investing, the amount of risk that you're taking on is pretty important to understand. So my guidance to all of you is that the amount of risk that you take on should be in some way correlated or proportional to the time horizon that you're investing in. So if you are investing money for a very, very short amount of time, 6 months, 1 year, 2 years, you do not want to take on a lot of risk. And we'll talk a little bit about why that is on the next slide. If you are investing for the medium term, 5, 7 years, or the long term, I would say, let's say 30 years, like retirement or, something longer, you can afford to take on more risk. And the reason that is that over the long run, when you invest in the stock market, over the long run, that tends to be the best performance, but it's quite volatile. And in the short term, you can actually lose a fair amount of money. And so if you need your money in the short term, you don't necessarily want that kind of volatility with money that you need. Let me give you an example. Let's say that you have a tuition bill due next year. You don't necessarily want to invest all of that in the stock market, because if the stock market happens to, crash in the short term and lose 30, 40, 50%, which has happened, you're stuck now with a tuition bill with half the money to pay that. Whereas if you're investing for something in 30 years, even if the market crashes right now, you have a long time for the market to recover and continue to perform well. Let me give you an example of that in quantitative terms. If you had invested $1,000 in stocks over the past, call it 60, 70 years, and you took what's the best and the worst 1 year performance that you could have had. The best year that stocks had, you actually made more than 50%. The worst though, you lost 27%. So if you're investing for the short term, do you and can you stomach a loss of a quarter of your money? Question you need to ask yourself. Now let's look at another question, which is if you had invested $1,000 and you looked at all the 25-year time frames over the last 70 years. So like let's say 1960 to 1985, 1965 to 1990, each of those kind of 25-year time periods, and you looked at what's the best and the worst performance that you could have had. Best case, you would have made 11% annualized every single year. Worst case, doesn't look as bad anymore. You would have made 8%. Now look, 8% a year, not as good as 11, but it's very, very different to still be positive and quite positive as opposed to losing a lot of your money. This is the same data represented in graphical form. You see here, this is the 1 year return, and then we have the 25-year return. You'll see two things happen as the time horizon that you're investing in increases. One is the delta, the difference between the best and the worst outcome, starts to shrink very much. In the 1 year example, the difference between the best and the worst is, call it 79 percentage points. Pretty big gap. In a 10-year time frame, it's about 16 percentage points. And then over a 25-year time frame, Best and the worst, there's only a gap of 3 percentage points. And the other key point, as we talked about, is the worst outcome starts to look a lot better. Once you start to get to a 10-year time frame, the worst outcome is you're still making money. It's not a lot, it could be 1%, 4%, but you're still making money. So again, the longer the time horizon you're investing for, the more risk you can take on. If you're investing for a very short time frame, my guidance to you would be do not invest that in relatively risky items like individual stocks or even fully stock-based mutual funds. This is just another kind of historical view. It's a bit more recent than the previous one. Between 1976 and 2 years ago, or a year and a half ago, 23, S&P 500, which again tracks the market, returned about 8.5% each year. And if you had reinvested any dividends that you got, it actually returned 11.5%. And this includes 7 huge downturns, which are called bear markets, that happened between that time, including in 2009, where the stock market fell by over half. And it actually includes the pandemic bear market, which happened in early 2022. So over time, the volatility that you might see smooths out, and you actually see a very positive upward trajectory for the stock market. Question came in, how do I decide to invest short or long term? Shouldn't I always invest long term? Well, the question is, it's not about whether you should invest short and long term, it's what are you investing for? So if you're investing, if you're thinking about trying to, have money for a down payment on a house and you want to buy a house in 3 years, I would say that that is a goal, that's a short-term goal. And therefore you should think about investing in instruments that have less risk. If you're talking about saving for retirement, that's something that's very far off, that would be long-term. So it's less about whether you should invest short and long term. It's more about defining the goals that you're trying to achieve and then saying, are those goals short-term goals, long-term goals, and kind of aligning your savings or investment strategy to that time frame. So this is just an article, and I wanted to call out a couple key points here around that volatility. This is by a New York Times columnist called Jeff Sommer, talking a little bit more about or reinforcing what we talked about, which is staying in the market for the long term is the best way to prosperity because you ride out any of the peaks and valleys. And going back to where we started with the penny example, the time in market tends to be one of the most important things. So the earlier you can start to invest and put money away, the better off you'll be. So one of the questions I often get is, great, you convinced me I want to invest in something, but where do I actually open an account? There's a lot of places that you can go. Let me give you a couple, kind of recommendations and maybe a caution or two. I really like a lot of the very large, reputable investment management companies like a Vanguard, a Fidelity, Schwab, BlackRock. These are companies that have been around for a very long time. They have a wide assortment of mutual funds, ETFs, and they charge very low fees and much lower fees than a lot of other companies for you to invest in. We'll talk towards the end a little bit about robo-advisors. Robo-advisors have come around in the last, call it 10, 15 years. These essentially are kind of a hybrid between doing it yourself and using a human financial advisor. They will ask you some questions, automate the investing, and then kind of invest your portfolio similarly to how we talked about. What are your goals? What's your time horizon? And they'll recommend an allocation that has, kind of an appropriate level of risk. I think some of these are really good, like a Betterment or a Wealthfront. There's a lot of others, partially because the underlying investments that they use oftentimes are from the likes of Vanguard and Fidelity. The caution, and this is a question that came up, which is, doesn't Robinhood advertise no fee? So a note of caution on Robinhood. Oftentimes, Robinhood, what you're investing in are individual stocks, not necessarily these low-cost mutual funds that are trying to be average. Even though the trading is no fee, I think oftentimes people take on more risk when they use a company like Robinhood. A lot of people, Robinhood grants them access to very sophisticated types of trades around, calls, puts, derivatives, things that are frankly beyond the expertise or the need of the vast majority of people. And what I would also caution is around the gamification that Robinhood provides, which I think sometimes incentivizes people to make more trades or invest more, take on more risk than they necessarily should. So my kind of recommendation is to try to kind of steer clear. This is not a case where you want to gamify the experience, really. This is one where you want to kind of rely on large, reputable investment management companies. Let me take a couple more questions that came in and then we'll move on. Does the finding that longer term tends to be less risky depend on the underlying stock market going up in value over time? Essentially, that's the actual insight, which is over time, historically, the stock market has tended and has in every single time period tended to go up over time in value. And even though there are periods of volatility, over the long run, you see a very much an up and to the right, kind of, phenomenon with the stock market. Now, yes, historical returns are not necessarily predictive of the future, but that's the best data that we have in terms of, the fact that the stock market will continue to, kind of outperform in the long run. In the short run, it may not. In a given year, the market may go down. But if you look at any, 10, 15, 20-year timeframes, any of those data points, the market has gone up over time. Are robo-advisors trustworthy? Like, why should I trust them and put my money in there? It's a question you should ask about any place that you put your money into. I would say that some of these larger robo-advisors have been around for a long time. The money that they're investing is, it's your money. It's not money that is, they're keeping in any type of other kind of account. I think you can trust those large, ones that have been around for a long time as much as you can, kind of trust any of these other, kind of companies. Unlike a bank or a credit union, what these investment management companies are investing your money in, actual kind of products, and those products are yours. It's not as if, the bank is then, it's not as if Vanguard is using your money to loan it out to, someone else, and there's a risk of them losing it. So it's a little bit different than, a credit union or a bank concept. All right, a couple more questions came in. I'll take these and then we'll move on just so we get to the rest. Thoughts on high yield savings accounts for students. Oops, sorry, I missed. Thoughts on high yield savings accounts for students with limited income to invest right now. I think high yield savings accounts are a great option if you are investing for the short term, putting money into an emergency fund, or frankly, just keeping money, kind of that you need on the side. Instead of investing, I think those accounts are great. Look, interest rates are pretty high right now. You can find a high yield savings account that's returning anywhere between 4 and 5% right now. It's trending down because interest rates have come down a little bit, but you can definitely be able to make 3-4% a year on your money by using a high yield savings account. If no employment, is trading a good option for a day-to-day living? I'm going to take that one as out of scope for this. My recommendation is it's probably maybe not, but there's a lot of kind of considerations within there. All right, I'm gonna punt the rest of these just because I want to get through some of the other content. I'm happy to take some more of these towards the end, either via email or there's actually a session after this that Raj, who's actually the financial advisor with the Harvard Federal Credit Union, will be on. They'll be able to kind of answer some additional thoughts around this and actually take some more questions. So again, given the time frame, I'm not going to be able to give you kind of all the detail, but if you were to ask me, what should you be investing in if you were investing in the medium and the long term, I would focus on passive, average, low-cost mutual funds or exchange-traded funds. These are diversifying you, they're convenient, they have lower cost, and I frankly don't have the time, and I think many of us don't have the time to devote to researching and staying on top of individual stocks. Those tend to be riskier. They require a lot of attention, and it's not as much of a guaranteed way of building long-term wealth. Now, look, There are many examples now of stocks that you'll see, especially in the headlines, that if you had invested in them, you would be, doing really, really, really well, right? Whether it's Microsoft, Nvidia, all of these. There are a lot of other stocks that over time companies have gone bankrupt or others. And so individual stocks tend to be riskier. The other point I make is that all of these stocks that people talk about in terms of, returning a ton like Nvidia or, Amazon or others, those are usually incorporated in those average mutual funds that are trying to track the market. Those essentially are, accounted for within those mutual funds. So by buying the mutual funds and by buying the market, you're also buying a portion of those. So when I'm thinking about mutual funds, I really focus on what I call index funds that are really just trying to track the market. They're passive, they're not looking to pick individual winners, and they're the average ones. The reason I like those is they're low cost. You don't pay as many fees. And again, over time, that market has tended to perform better than individual managers or stock experts who are trying to beat the market. Those kind of funds tend to have higher fees. And what I'll show you in a couple of different examples, frankly, research shows many are not able to consistently beat the market. This is a study that was done, back in 2014, I think. They took the top quartile of funds that were actively managed, where people were trying to intentionally beat the market. And there were about 2,800 of those in 2010. And they looked at which of those stayed in the top quartile over the past, next 4 years. And you can see the answer, 2. Only 2 of them actually stayed in the top 10 or the top quartile over time. Here's another view of this, and this is data from the Dow Jones kind of indice report. If you look at the percentage of active managers who have lagged the market over a 1-year time frame, 72%. 5-year time frame, 73. Over a 10-year time frame, it jumps to 90. And if you look at the last 20 years, 93% have lagged the market. The other way is to reframe it as how many people can actually beat the market. And let's just look at the long-term trajectory here. Over a 20-year time frame, only 7% of active stock managers have actually beaten the market. So that's great. Some of them have. Can you identify those? Or are you going to buy, ones that might be in the 93%? And again, in this case, the majority are actually lagging the market, and you may be better off investing just in the market and actually outperforming 93% of those managers. So I want to talk about a little bit about kind of any advice that you may want to get, and then we'll talk a little bit about putting together a portfolio. You may find at any point that you want to have some help with investing, and you may turn to a person, a financial advisor. My recommendation is that anyone you go to that is gonna help you with your investing is a fiduciary. Fiduciary is a term, it's a legal term, and it means that the person has a duty of care to put your interests above anything else, including their own. To me, this is like table stakes and should be kind of a no-brainer. Anybody that's giving you advice should be putting your interests first. But unfortunately, not every person that's giving you financial advice has that legal care. And so you need to kind of ask yourself and ask that person, do you have a fiduciary duty? To me, this is an absolute minimum that I want all of you to remember as you think about it. Reason for that is a lot of studies show that people who are not fiduciaries are conflicted and give suboptimal advice. There was a report that came out in 2015, showed that Americans lose about $15 billion a year on conflicted financial advice. So just remember that. So let's say you're putting together a sample portfolio for the long run. You're investing something that you don't need for 10, 20 years. Here's a sample portfolio. This is one that is investing heavily into mutual funds that are stock-based. 60% is invested in US mutual funds, large companies and small companies. Some of it is invested in international. This is a sample portfolio that may want to work. There is no right answer about how to allocate. You will find as many different points of view on this. These are all pretty reputable sources, and you can see that they differ in terms of the number of investment items that should even go into your portfolio, as well as the allocation of them. There is no right answer, and you really need to kind of think through kind of the allocation as well as what it is that you're trying to kind of invest for. If you were to think about the long term, this is from an article in Forbes that a colleague of mine wrote. This is just another example of building a long term, let's say a retirement 3-fund portfolio. You could do it with Vanguard, Fidelity, with a lot of other investment management providers, but this actually gives you the specific mutual funds that you could use to build that long term portfolio. Let's take Fidelity as the example here. You could invest in the Fidelity Total Market Index Fund for the stock portion, the Total International Index Fund for the international portion, and the Bond Index Fund for the bond portion. So if you were to go to Fidelity, you'd open up an investment account, you would transfer some money into, and then they would ask you, okay, what do you want to invest in? And you could do research in a lot of different ways, but you could actually look at these tickers and invest your money according to this. So if you invested $1,000, you would put 550 into this first fund, 350 into the second, and then $100 into the third. Let me jump a little bit ahead. On the robo-advisor side, just to give a little bit more detail here, if you were to go to a robo-advisor, they're going to follow the process that I essentially walked you through before. This is just an example from Betterment. You'd open up an account, they'd actually ask you, what is the goal that you're saving for? And the reason they're asking for that is because they want to get at the time horizon. And they would want to think through, kind of what you're looking at. So, let's say you could put in a couple different goals, and they would ask you the time horizon, and also what is the amount that you need for that goal at the end of that time. So let's look at a couple different options here. Let's say you wanted to have an emergency net goal, and I purposely am putting big numbers here, like $10,000 in 2 years. They would recommend a portfolio that is not as risky. They would put a little bit into stocks because it's 2 years, but the majority would be in bonds and kind of other short, less risky items. Let's say you wanted to kind of save for a big purchase in 5 years. They would weight you a bit more towards the stock market. And you can see that if you were saving for something that's much longer term, let's say, tuition for, a newborn baby, 18 years in the future, you would see that it would be much, much more heavily weighted towards stocks. So if I had to sum up some of the advice, take the long-term approach, look at using low-cost index funds consistently buy, and allocate your money in a risk-based way based on the time horizon. Don't try to time the market. Try to put money in consistently and try not to sell when things look scary. There is one of the most famous investment books is called A Random Walk Down Wall Street. It really advocates the approach that I've been talking you through, which is the average approach, index funds, very passive. A couple of years ago, Peter Coy, who's a New York Times columnist, interviewed the author Burton Malkiel on the 50th anniversary. And this is one of the quotes that I loved from that interview, which is, "It is not often in life that the easy thing to do is the smart thing to do." And in this case, the easy thing is to invest in the stock market, index funds, passive instruments. Those are the easy things. It also turns out to be the smart approach. A couple of thoughts here. I'm going to give some resources. I'll turn to the questions and then a couple other intros I want to make. If this has piqued your interest, I put some curated list of suggested resources depending on what your favorite medium of consumption is: books, websites, blogs, podcasts. If you're looking for financial advisors, there's a couple options. One, and I'll turn over to him in a minute, but the credit union has its very own investment advisor. His name is Raj. He'll jump on in a minute, and he's going to co-host the next session in about 30 minutes. If you want to learn more or talk to somebody one-on-one, he would be a great resource for you to use. If you are looking for other kind of fiduciary fee-only type of planners, the XY Planning Network is a list of planners who are focused on, kind of the younger generations, if you will. At that point, it was, Gen X and Y, and also younger. I think those would be kind of great resources to go to. So I want to take a few minutes just to go back to some of the questions that have come in. Feel free to kind of keep asking those. And then with a few minutes left, there's a little bit more content we'll go through. Question came in. I've always wanted to start investing a little bit outside my regular retirement plan. What is the process like to pick a broker, and how do I start? Who do I trust? What do I look for? Signed, complete beginner. Great question. So my recommendation is, as a broker, you look for basically an investment management company like a Vanguard, a Fidelity, others. You want to look for companies that are big, they've been around for a long time, and ones that offer you an array of mutual funds or exchange traded funds that have very low cost and offer you at least a significant portion that are passive, meaning they're not actively trying to beat the market. You want to look a little bit at the track record of those companies, like, the companies I keep mentioning, they've been around for decades. They have trillions of dollars, kind of invested as you go through there. I would recommend that over an individual broker, or others. If you mean, if by broker you mean financial advisor, that's a little bit of a different question. For that, I would say minimum filter by fiduciary. Then I think you want to go and you actually want to interview 2 or 3 different financial advisors, and you want to ask them questions. And I'll actually point you to an article by Tara Siegel Bernard. She's actually listed here in the columnist. She actually wrote a couple articles, including 21 questions that you should ask your financial advisor. I think it's a great article. One of those questions is, are you a fiduciary? But she gives a lot of others and a little bit of the process. What you want to talk to that person about, like, what is their investing philosophy? How will they interact with you? How much do they charge? What is the fee structure? Can they show you a sample statement? And can they explain it to you in a very simple, non-intuitive way? So I would start with, if you're looking for a human financial advisor, I would look up that article by Tara Siegel Bernard, and I would use those questions as a good guide. Question came in, others. What do you think about Charles Schwab, pros and cons? I like Charles Schwab a lot. I put them in the category of large, blue chip, kind of investment management companies. They do offer a lot of, very low cost index funds. They also offer some funds that are, a bit more expensive, but to me, they're a great option as well in terms of, kind of where you want to think about. Question came in around that slide that I put up around, I put a red box around some, and specifically around Ameritrade and Schwab. I didn't mean to kind of zoom those out. I actually just wanted to kind of exclude Robinhood from those. So don't read into too much that Ameritrade and Schwab were not included. I was just trying to highlight a few of the examples like Vanguard and Fidelity as just sample illustrative ones, if you will. A question came in around, and maybe this is a question that came in around. If you use a financial advisor, some of them will charge you a certain amount of the money that you have invested for them. It's called, kind of assets under management. And typical rates could be, 1% of the money that, you're investing in all. There's a lot of considerations around using a financial advisor and, kind of the fees and the services that are in there. I would say those are probably beyond the scope of this. This is something you may be able to cover a little bit later with Raj, or happy to kind of answer questions, beyond. Question came in. What about Trump coin? Dave Portnoy made $1 million in a few hours. Yes, made $1 million in a few hours. I can point to a ton of people who have lost an equivalent amount or more in any type of investment, whether it's Bitcoin or others. Bitcoin is becoming a more established asset class. It is still very risky. If you are so inclined to invest in, crypto, my recommendation, and again, this is if you, feel you must, there are now some mutual funds or exchange traded funds that are focused on crypto, and at least that's diversifying you across different types of crypto coins. I would still put this as, on the more risky side, and I would caution you about putting a big part of your portfolio in crypto. Yes, a lot of headlines about people making a ton. You often don't hear as much about the people who've lost a ton. Question came in, can you or should you invest your student loan money? Good question. So what I mean by this is most likely when you take out student loans, you will get, usually you get an amount that covers tuition and also living expenses. So usually the money goes, your tuition is deducted, and you get kind of a student loan, quote unquote, refund. That is money that's given to you that you're supposed to use for expenses. Look, that money oftentimes is supposed to be used in the short term, right? For food, clothing, textbooks, etc. As we talked about, I don't think you should be investing money that you need in the short term. Money that you have beyond, like, are you saying if you're taking out more money? Look, it depends on the interest rate of your student loan and the amount that you think you can make. Oftentimes, especially now, student loans are 5, 6, 7%. I don't know if you necessarily want to take on the risk of investing that money when the stock market in the long run is returning 6, 7, 8%. You may not necessarily make more, and it would take a while for that to kind of break even. All right, a lot more questions are coming in. I'm going to take about 2 more, and then the rest I'll say we can save for later. Or feel free to to kind of email me offline. Index funds, what are index funds and what is so advantageous to them? So index funds are essentially ones that are just trying to track a stock market index. So an index is just meant to be like a benchmark. And you may have heard of like the Dow Jones, the NASDAQ. These are just, kind of meant to be kind of portions or big portions of the overall stock market. So an index fund is essentially indexing its performance to that market. It's not trying to outperform that, that portion of the market. And the reason it's advantageous is because it's just trying to, mimic the performance of the market. It tends to have much lower fees. And what's been proven over time is that that actually tends to perform better than people who are trying to actively beat the market. So it's lower fees, and over the long run, in most cases, tends to be better performance. Let's see. Can I do a consultation with you? So I don't do one-on-one consultations. Raj, on the other hand, does. And so that would be, I think he would be a good resource, or, kind of any of these other ones that we're talking about. But I purposely stay away from one-on-one because I want to avoid that conflict of interest in the information that I'm giving you. So unfortunately, that is not possible. So I know we've talked a lot. I'm going to leave the other questions for later. I know we talked a lot about Raj, but I wanted to kind of use this moment, and I'll pass it over to Ty to actually introduce Raj to you, and then we'll cover a couple other slides as well. But just want to say thank you, everyone, for joining. Feel free to email with questions, and best of luck with your semester.
Thank you so much, Shahar. All right, Raj, I think is actually here. Raj, if you want to hop off mute real quick. So this is Raj. He's our very own financial advisor here at the Harvard Federal Credit Union. He generally works right here at our branch in Harvard Square at 104 Mount Auburn, but he visits our other branches as well. This is just a brief little intro to Raj because we are actually going to be doing another presentation today, him and I. That starts in about a half an hour after this one. So if you have any interest, or there's some more unanswered questions or anything like that, or you want to know the next steps for your own personal situation, whether or not you want to set up an appointment with Raj, or maybe come to our next presentation and try to ask some more questions, we would love to have you do that. But this is Raj.
Morning, everyone. Hope everyone's staying warm. I'm sure you had a great session, and we have, as Ty said, another one lined up for you in about half hour. So hopefully you can all join us for that as well.
All right. Thank you very much, Raj. Shahar, if there's anything else you wanted to hit on before you go, feel free to, but if not, then we can move on with our day.
Yeah, I think, from there, I know there's kind of questions there. I think, here's kind of Raj's information. We have a little bit on mine, but I think, we're coming close on time, so it might be, a good place to call it.
Yeah, absolutely. And I know that there's still some outstanding questions, but thank you everyone for being so interested and passionate about this. We have some follow-up emails if you want to reach out to Shahar or to Raj, set up an appointment. with Raj specifically, you can. And as well as Jen mentioned in the chat that all of these slides are going to be sent out automatically to everybody registered with the webinar today. I know there's a lot of those slides that had a lot of like really dense information on there. So please look forward to reviewing some of those. Hopefully that'll help with some of the questions as well. But like I mentioned a couple times, we have another presentation about half an hour. It is called the Gen Z Guide to Wealth Building, but that's going to be run by Raj and I. So it'll touch on a lot of these sort of investment topics as well. So feel free to follow up there or via another email or anything like that if you'd like to. But thank you guys so much for joining us today. And we're always looking to hear feedback and to help you follow up. So feel free to reach out, set up an appointment, or join us on our next presentation. All right, but for now, that's going to be all for us today. Thank you again for joining us, and good luck with everything. Stay warm out there, and we'll see you all later.